Netflix has been on a tear this year, up more than 100% in 2018, and one analyst sees more upside ahead. GBH Insights is raising its target on the stock to $500. If you don't know GBH, you probably know the analyst at the firm. It's Dan Ives. Well-known person, been on the show many times. $500 makes sense. And by the way, you have a couple of other positive calls on Netflix today. Piper and Monness Crespi Hart. So let's take it, Pete.
And Mark Mahaney's been one of the guys who's been on this story for years, right? I mean, it's well, there's
except for Packer.
Yeah.
Sorry, Michael.
You know, but it's true. But
it's true, right?
It is true. But you know, the focus has been, can they grow internationally? They have. Are the margins starting to improve? They are. They just seem to have so many different levers that are working right now for Netflix, and the fact that they've got this moat. So there's a multiple of different reasons why, Scott, this stock can continue to go to the upside. The toughest thing, I think, for all of us is we know they have great cash flows. The multiple is just insane to look at that. And that's what makes it so difficult, and that's what's made so many people on the wrong side of this thing.
You think they're going to get the sub growth, which Dan Ives does. But
yes.
It goes from 400 to 500. This isn't just
and specifically,
bumping it by $25.
And they're even going back and looking at the United States, and they're talking about the fact that, hey, look, North America, we're going to see some growth there. That's something that nobody really had brought up before. It's all been, and for me, it's a lot like Nike, right? Nike, the reason it's doing so well is the international growth. That's where their strength is. This is a company, though, when you look at what they're doing versus Amazon versus Hulu, they are double engagement time per week. That's impressive.
When you look at Disney right now, and not to say they will succeed or fail on what their objective is, but they keep talking about direct to consumer, and that seems to be the objective. Direct, and now you look at what Netflix has been able to do over the last couple of years and really overcome a lot of obstacles on the balance sheet, because to acquire that content, to have that international growth that we're talking about, which has been fantastic, they have had to go out and spend. And a lot on the street, myself included, have been very suspicious of their ability with the rich valuation for them to continue to appreciate that environment. But they've been able to do it. And now they've created an environment where, from a balance sheet standpoint, they're in a far better position than they were 3-4 years ago, and they have the ability, I think, to reach the targets internationally if they have to tap the balance sheet.
So two things on this. One of the things that I try to do with stocks that are trading in the hundreds, and you hear about it, somebody says $500, I just reduce it by
drop a zero?
No, I just say it's a $39 stock going to 50. Big
right,
deal.
Drop a zero.
Okay, so that's number one. Number two. Let's do the counterfactual. Let's imagine a world where Netflix listened to Wall Street in 2011, and Wall Street threw a fit when they announced an international expansion. And let's say they backed off of that. And then let's also say they prioritized earnings, and they thought about, well, our multiple or whatever, and they tried to drop as much of their revenue to the bottom line, like a traditional media company has been doing and would have done. In that world, does Netflix have even a tenth of the subs that they have? No. Any of the revenue? Probably not. Any of this international revenue? Obviously they wouldn't. And in that world, Netflix is probably gone by now, probably swallowed up by someone else, or it looks like Pandora trading single digits because the bigger guys got there first. This has always been a scale game on an international level, and Netflix rightly saw that when a lot of people, and I'm not saying I was that early either, a lot of people said, too much of a risk, they're not going to be able to do it, too much competition. They said, you know what, if we don't go for it, what will we look like in 5 years? And it was the right bet.
One other point to make is the M&A merger, the M&A activity from the media giants has done nothing to impede the growth of Netflix. And you would have thought that they were all trying to merge to basically go after Netflix, right? Stop the growth. The growth continues to accelerate. They continue to try and merge.
Well,
all they're doing is
that one is in the position of strength. The others are making moves to try and keep up with the Joneses,
and also to gain some market share, which they don't. By merging, they haven't been able to gain that market share at all.
All they're doing is adding $100 billion in debt. They're smashing properties together in the hopes that they will be able to create content, but the distribution has proven to be the secret sauce. Netflix's technology is so good, so ubiquitous, preloaded onto television sets before people buy them. The app, it all works seamlessly, and I think that that's not going to be so easy. I'm not saying Disney's not going to have an amazing offering, but but it's not a slam dunk that just because it's ESPN, Marvel, and Star Wars that they're going to all of a sudden be a real threat to Netflix. It's not a slam dunk. I wouldn't bet on it.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.